Today, we are diving into an absolute giant of finance, Benjamin Graham's The Intelligent Investor. Now, this isn't just another book about picking stocks. You got to understand, this is a foundational text. It's a complete philosophy for how to think about the market and, maybe more importantly, how to control the one person who can do the most damage to your portfolio, which is, of course, yourself. And Graham's philosophy gives us the tools to do just that.
So it all really boils down to this one big question. Is the market some logical, predictable machine where the best companies always come out on top? Or is it more of a chaotic roller coaster, just driven by the very human emotions of fear and greed? Well, Graham's entire philosophy is basically designed to solve this exact problem, giving you a framework to navigate all that madness.
So how does he do it? Well, Graham kicks things off with a pretty radical idea that honestly changes everything. He asks you to completely stop thinking like you're playing a game, like you're placing bets, and instead start thinking like you're actually buying a business. And look, Graham's definition of investment is super strict, and this is really the key to everything. It has to meet all three of these conditions. You've done a thorough analysis, you're promised safety for your original capital, and you can expect a reasonable return. If it doesn't tick every single one of those boxes, it's not a bad investment, it's not an investment at all. He calls it what it is, speculation.
And this just lays out the two paths perfectly. See, the speculator, they're just obsessed with the stock price. Their one big question is, what's the crowd going to do next? The investor, on the other hand, couldn't care less about all that daily noise. They ask a much more powerful question. What is the underlying business actually worth? That simple little shift in perspective, well, that's the first huge step toward becoming an intelligent investor.
Okay, so to really get this mindset locked in, Graham gives us one of the most brilliant allegories in all of finance. It's a way to not just understand the market's wild mood swings, but to actually turn them into your advantage. So let's meet your new business partner. Graham asks you to imagine this. You own a piece of a business, and you have a partner named Mr. Market. The only problem is your partner, well, he's a total manic depressive. He is completely driven by his emotions, and every single day, without fail, he shows up at your door to make you an offer. On his good days, right, he is just totally euphoric. He sees nothing but clear skies ahead and offers to buy your shares for way, way more than they're worth. The kind of prices that create that FOMO, that fear of missing out. But on his bad days, he's deeply depressed, he's totally convinced the world is ending, and offers to sell you his shares for just pennies on the dollar, fueling all that panic selling. The key thing to get here is that his prices have nothing to do with the business's real value. Only his mood.
And this, right here, is the absolute genius of the whole thing. You are under zero obligation to trade with this guy. You can just ignore him completely. Or, even better, you can use his emotional instability for your own benefit. You sell to him when he's feeling euphoric and overpaying, and you buy from him when he's panicking and selling everything on the cheap. You profit from his foolishness instead of getting sucked into it.
All right, so we've got the mindset down, and we've got the psychological defense against Mr. Market. Now let's dig into the practical defensive tools Graham gives us to actually protect our money. This is it. I mean, if you remember only one concept from Graham, please make it this one, the margin of safety. This is the absolute cornerstone of his entire philosophy. Think of it as a buffer, a cushion against bad luck, mistakes in your own judgment, and of course the wild swings of Mr. Market. Let's break down exactly how it works. Okay, so first things first. Through your thorough analysis, you figure out what you believe the business is actually worth, its intrinsic value. Let's say, after all your homework, you calculate that value to be $100 a share. Now here's the trick. You don't buy it at $100. You don't even buy it at 90. You wait. You patiently wait for Mr. Market to have one of his bad days, and he comes to you offering to sell it for just $60 a share. That is the price you pay. That gap, the difference between the $100 value you calculated and the $60 price you paid, that is your margin of safety. In this case, it's a massive 40% buffer. So what does that mean? It means even if you were a little bit wrong in your analysis, even if the economy takes a nosedive, you have this huge cushion protecting you from a permanent loss of capital. You see, you're not trying to perfectly predict the future, you're building a defense so you don't have to.
Now, Graham was a realist. He knew that this kind of deep dive isn't for everyone. So he laid out two paths. The defensive investor is someone who wants simplicity, freedom from making constant decisions. For them, a simple, diversified portfolio, say 50-50 stocks and bonds, is the best way to go. The enterprising investor, on the other hand, is willing to put in the real time and effort to hunt for those bargain stocks with that big margin of safety. Graham's big warning, though, is that you have to be brutally honest with yourself about which one you really are.
This whole philosophy, focusing on value, ignoring the crowd, always demanding a margin of safety, this wasn't just some abstract strategy. It was a direct shot across the bow at some of the most popular ideas on Wall Street, both back then and still today.
Let's put it head-to-head with what's called growth investing. Graham's value approach is all about buying solid, established companies at a bargain price. Growth investing is the total opposite. It's about buying exciting, often younger companies and paying a really high price today based on the hope of huge profits way out in the future. Graham's approach is based on what a business is worth now. Growth investing is a bet on what it might become.
And it's not just growth investing he's pushing back on. Graham's whole philosophy also flies directly in the face of a major academic theory called the efficient market hypothesis. Basically, this theory says stock prices always reflect all the available information, which makes it impossible to ever find a real bargain. But Graham's entire concept of Mr. Market is built on the exact opposite idea, that the market is not efficient, it's emotional and irrational, and it's constantly creating opportunities for the disciplined investor.
So you might be thinking, okay, this was written back in 1949. With all the changes in technology and the economy, does any of this stuff still hold up? And the answer is a resounding yes. Why? Because these ideas were never about formulas or market conditions. They were about human nature.
And hey, you don't have to take my word for it. Warren Buffett, Graham's most famous student and maybe the greatest investor of all time, has said this book is the bedrock of his own investing for more than 60 years. I mean, that's a pretty powerful endorsement right there.
So when you really boil it all down, what are the forever rules? It's these. Treat stocks like you're buying a piece of a business, not a lottery ticket. See market volatility as your friend, not your enemy. Always, always build in that buffer for error. And most importantly, have the patience and the discipline to stick to your plan when everyone else is losing their mind.
And this really gets to the ultimate takeaway. The intelligence that Graham is talking about has absolutely nothing to do with your IQ or having a PhD in finance. It's about character. It's about having the emotional strength to think for yourself and act rationally when everyone around you is just running on pure impulse.
Because in the end, Mr. Market will always be manic depressive. The cycles of fear and greed, that's a permanent part of the landscape. The only variable in this whole equation that you can actually control is you. So the final question Graham leaves us with isn't about the market at all. It's about ourselves. The market's mood will always swing. The real question is, will your discipline?